Hey, this is Michael Cuozzo with Condor Capital Wealth Management, and today we're going to talk about why doing nothing is sometimes a deliberate financial decision. When people think about investing, they often assume progress comes from doing something, making changes, moving money, reacting to what's happening in the market. But one of the more underappreciated financial decisions is knowing when not to act. And that's not because markets are calm, it's because volatility is normal. Historically, the stock market experiences a decline of 10% or more in about half of all calendar years, and smaller pullbacks happen almost every year. Even in years that end up positive, the path getting there is often uncomfortable. In fact, the S&P 500 has spent roughly 40% of its history in some form of drawdown from a prior peak. Volatility isn't the exception, it's the baseline. This is where doing nothing starts to matter. When portfolios are built with this reality in mind, diversification, liquidity, and time horizon, they don't need to respond to every dip or headline. Many short-term fluctuations simply fall within what was already expected. Another reason inaction can be intentional is that market returns aren't evenly distributed. Over long periods, a surprisingly large portion of market gains comes from a very small number of trading days. In fact, data shows that if an investor missed just the 10 best days in the market over the past few decades, their returns would have been cut roughly in half. Missing more of those strong days and the impact compounds quickly. The challenge is that those best days often occur very close to the worst days, frequently during periods of high stress and uncertainty. Trying to step out and avoid volatility means risking missing the recovery. This is where we see the biggest pitfall of action. Data on investor behavior consistently show that the average investor underperforms the market, not because of poor investments, but because of poor timing decisions, selling during downturns, re-entering after rebounds. In other words, doing something at the wrong time can quietly erode returns far more than staying put through the volatility. That doesn't mean doing nothing is always the right answer. It means that when the plan is still valid, goals haven't changed, time horizon is intact, and risk was already accounted for, inaction can be a disciplined choice. Often the most productive decision is allowing the structure of the plan to work as intended. The takeaway isn't that markets should be ignored, it's that reacting to every fluctuation can induce more risk, more taxes, more costs, and more regret than it prevents. Sometimes doing nothing isn't indecision, it's patience backed by data.